Okay, thanks. So we come now to the final hour of the day, international tax. And we thought this year what we would do is to try to make this a little more interesting is to actually use a case study of a scenario that we see come up again and again and again throughout. I'll be presenting along with Fiona Xu. She's a tax lawyer here at Royse Law Firm. You all know me, I'm Roger Royse. We both do this kind of work. And let me tell you what the fact scenario is, and then we'll jump right into the issues. If I can see it. So at some point, in our practice, we work with a lot of startup companies, and oftentimes startups, they don't really want to do this kind of fancy planning right at the start. Sometimes they do, but it's very expensive, and they don't have any income anyway, so why bother? Sort of their view. But at some point in their life, they're going to get to the point where they decide it makes sense to move offshore. Maybe they've got an offshore investor, maybe they don't. And so oftentimes we'll get involved at a stage where things are really very simple. There's just one company. It's a U.S. company, probably a Delaware corporation, and now they've decided that they're going to be profitable, they're going to have a worldwide market, they're going to have people all over the world, and it makes sense to deal with our current tax situation. And our current tax situation, by the way, is that the United States has finally beat Japan at something. We have the highest top marginal tax rate in the world of the industrialized nation. Plus, we've got California on top of that. Because of that, there's a lot of interest in, I'm not telling you anything you haven't read in the papers and heard at the presidential debates. There's a lot of interest in moving money offshore and not bringing it back. And that's what a lot of this sort of planning is about. So we're going to start with the outbound planning. If we have time at the end, we'll talk a little bit about inbound planning. So here's the scenario. We have our new U.S. company now, holding company, our Delaware corporation. And the idea is we're going to split the U.S. and the foreign operations. And the best that we're going to get out of this whole structure is we're going to get a little bit of deferral of tax on the foreign earnings. As long as we keep, what we'd like to have happen is we would like to not be taxed in the U.S. on our foreign earnings as long as we leave them offshore. Now, I will tell you that there's always all sorts of proposals dealing with this, taking a lot different approaches on this. In fact, Donald Trump's tax plan would end deferral altogether and just tax all that income back in the U.S., whether it's owned offshore, whether it's earned in foreign countries or earned here. But I really doubt that's going to happen under any administration. We've had these rules in place since the time of John Kennedy, and I think it would be very disruptive if we were to change the anti-deferral regime, or the deferral regime that we have. Congress will continue to monkey around with some of these anti-deferral rules that we're going to talk about in a minute, but I think this is a structure that's going to stay for a little while anyway. So keep in mind, we want to split the foreign from the U.S. To do that, we're going to have a foreign IP holding company in the structure and a U.S. holding company. Now, the IP holding company, what we want it to end up owning are the foreign intellectual property rights, and we want the U.S. company to own the U.S. rights. So, number one, after we form these entities, you'll notice we split the U.S. and the foreign rights up. The U.S. company has the U.S. rights to exploit the company's technology. And by the way, I deal with all technology companies, so we're talking about tech or intangibles actually here. And the foreign company has the foreign rights, and we do that normally through a cost-sharing agreement. Now, a cost-sharing agreement is an agreement, it's expressly authorized by the Treasury regulations, and it allows the companies to share the costs of developing technology, provided that they share the costs based on the relative expected benefits from the technology. I'm going to talk about a few cases on how we come up with this in a minute, but that's the general idea. So the benefit of that is that if we have cost sharing, we don't have to have one company own the IP and then license it to another. Because if we do that, first of all, we have to figure out what the license fee is, then we have to worry about withholding taxes. With cost sharing, they just enter into one agreement that says, you, the U.S. company, you have the U.S. rights, you, the foreign company, you have the foreign rights. If that IP has already been developed, one company is going to have to make a buy-in payment based on the value of that IP, which is going to require a transfer price study or evaluation at some point. But step number one, we split the IP up, U.S. and foreign rights. And that's, I guess I got a pointer here. So here's our U.S. company, here's our international company, there's our cost-sharing agreement that splits the IP. Now, on the U.S. side, we'll have a license agreement to our manufacturing company. We'll possibly have sales companies, things like that underneath. But this is not tax-driven, this side here. This is more liability-driven. In other words, I would rather not have the IP and the business operations residing in the same entity if I don't have to for liability purposes. On the tax, this is all tax-driven on this side. So IP holding company now, usually in a low tax jurisdiction, will form its base companies. The base companies are actually conducting the business of the foreign operation, and it's licensing the intellectual property from the IP holding company. It is actually paying a license fee. Now, we check boxes down here. Okay, for those of you that, by the way, how many of you do international tax work in your practice? Okay, so you all know all this stuff. We check the box. No, okay. We check the boxes so that these companies are treated as disregarded entities. We're going to go into why that is in a minute, but that's what we do right now. So as a tax matter, this IP holding company is treated as doing business in all of these places for U.S. tax purposes, but not for foreign tax purposes. So this Singapore company is not subject to tax in India. Instead, India is earning its income, then making a deductible payment out to Singapore and reducing its tax base in India. That's the general idea. Now we're going to go through all the ways we can get in trouble with that and all the issues we have to navigate. I'm going to let Fiona talk a little bit about the 4 anti-deferral regimes that we're going to talk about here.
Okay, thank you, Roger. I saw a lot of people raise their hands, so they had practiced international tax. That makes my job easier. I will start with CFC and subpart F income. So a CFC is a controlled foreign corporation, which by definition is a foreign corporation owned more than 50% by U.S. Shareholders by vote or by value. And under that definition, there are 2 points which is interesting and in practice. The first is you have to be a U.S. shareholder, and that's actually a defined term under the tax code, which means not every U.S. person can be a U.S. shareholder for CFC purpose. To be a U.S. shareholder, you must own at least 10% of the company's stock. So say if we have 11 U.S. shareholders who owns 100% of a foreign corporation, and if they own the stock ratably, then you don't have a CFC, although that foreign corporation is 100% owned by U.S. person. But in practice, we don't see that happen very often. The reason is that the attribution rules apply. So you have to be truly separated person or entity. You cannot be family members, or you cannot be entities within the same company group that ultimately owned by the same interests. And another point is the 50-50. You must be you must be owned more than 50% by value or by vote of the foreign corporation. There was to give an example that if you have a foreign corporation which is owned 50% by a U.S. shareholder and 50% by a foreign person, that is not a CFC, as long as you carefully maintain the value and the vote even between the 2 shareholders. But we see that in practice, but you need to be careful that if the company have more than 1 class of stock, or if the company have preferred stocks which it issued to different investors, then that may ruin the whole status of the foreign corporation to be a CFC. What coming to my mind, firstly, is say if we have a U.S. investor who contributes some IP to the company, and we say a lot that the person who contributes the IP would think about, when we contribute, the IP has no established value. But if in the future it is proved to be more valuable than now, we want to receive that benefit. So what is common, as we see in the joint venture agreement, that it will put in provision in the future when the value of that IP is better established, there's some way that gave more value to the U.S. investor. But in the 50% ownership case, you must be careful, because that will ruin the status of the foreign corporation, because the U.S. shareholder will have more value in the future. CFC, what's the consequence of a CFC is all the subpart F income of the CFC would be currently taxable as a deemed dividend. The subpart F income, which means the income listed on the subchapter F of the tax code, in general, it means passive income, like dividends, interests, royalties, but there are certain exceptions as listed, like the active royalties, which means royalties that generated in active business is not subpart F income. And there are under two situations that active business income may be considered as subpart F income as well. That is the foreign-based company income. We would talk separately later. So back to the example, what we see here is the international IP holding company in Singapore would be a CFC because it's 100% owned by the U.S. company, and because it receives royalty from the operating companies. So as Roger suggested, what we did is we checked the box of those operating corporations. By checking the box, the corporations are disregarded. The holding company in Singapore and all the operating subsidiaries down here will be deemed as a single corporation. And we eliminate the royalty paid here because from the U.S. tax purpose, you are actually paying royalties to yourself. And that's not considered income to the holding company and eliminated the subpart F income. But there's one situation under here which is fine for our structure because in our structure that the Japan operating company only providing services and business within Japan and the Singapore and Canada as well. But if the Japan company, for example, also providing services to a Chinese customer, then they will be subpart F income, which falls into the foreign-based company income rule. So that will not necessarily be solved by checking the box. We will discuss it later. And another issue we need to point out here is remember the withholding tax. So back to the example, although by checking the box, we eliminated the royalty and the subpart F income here, you need to be aware that Japan and Canada will impose withholding tax on any royalty it pays to a foreign corporation. So in practice, we say a lot, when designing the structure, we will think about where to choose the operating company. That's part of the reason is for business purpose, and another part is from tax point of view. You want to find a country which has tax treaty with the country of the holding company that eliminates with the withholding tax rate any royalty or dividend it will pay to the holding company. And Another issue is about checking the box. There is a list which you could find on the IRS website that we call the per se company rule. That is, the IRS provide a list of the type of foreign corporation which check the box rule does not apply. So if you form a corporation, for example, in Japan, that is a per se corporation for U.S. tax purpose, then you cannot check the box to treat it as a disregarded entity, and the whole structure will not work. So there are two things people need to bear in mind when designing the international structure. And I just said that there are two situations where active business income may be deemed as subpart F income and subject to the current tax. One is the foreign-based company sales income, and another one is the foreign-based company service income. So the sales income is over here. That the idea is you choose the location of the sales company only for tax purpose. You do not do any substantial modification here. The sales company purchase from the manufacturer company, which is a related party here, and sell it out of the country it's incorporated to the customers in other country. So the idea is to eliminate the tax deferral here and treat the income of the sales company as a deemed dividend to the manufacturer company and tax it currently. Okay, the definition is you purchase from or sell to a related party outside of the CFC's country of incorporation, and you did not do any significant modification at the CFC's country. I'm sorry, the CFC does not provide significant modification. And some taxpayer once came with a pretty genius structure to get around of this foreign-based sales income rule. And what they did is they form a partnership here. And the partnership actually, it can be everywhere. It can be a partnership on the paper. And it did nothing but just, take the income from the end customers, and then the sales distribute 90% of the income to the sales company and 2% to an unrelated individual or an entity. So people were thinking that they would get out of the foreign-based company sales income because by definition, the sales income must be received by a corporation, not a partnership. So they made an argument that we do not have sales income here. For the sales company in Luxembourg, the only income it has is its share of the profits from the partnership, not any sales income. And the taxpayer in that case won the argument. The tax court agreed, and the IRS lost. So it was just a simple structure and with no substance, just a form here. And the IRS was pretty unhappy. They have the regulation after that case to eliminate the structure, the benefit of that structure. So it does not work anymore. And another issue is the foreign-based company service income, which I said earlier that if for example, the Japan company providing services to Chinese customers, then it performs services on behalf of the Singapore holding company, and then it's providing services out of the country of incorporation, and it creates foreign-based company service income, which is subject to subpart F2. And there was thought that people will get around of it by forming a partnership just like what they did for the foreign company's sales income, which under the new regulation would not work as well. And also, it does not work because of the substantial assistance rule for the foreign-based company service income. Do you want to add anything on the service income? Okay. Okay. Then I move to PFIC, the Passive Foreign Investment Company rule. I modified the case a little bit because PFIC was not an issue for our structure originally.
Before you go on, I want to make sure everybody understands this.
Okay.
Why this works. Can you see the pointer for a second? So just so we get the essential point here, because that was a lot of law and a lot of regulations. What we're saying is that if we don't check the box here, we have a royalty that goes back to Singapore, and that's foreign personal holding company income. That's subpart F income. That gets taxed back to the, let's go back here. That gets taxed back to the owner here. This new company is the owner. All right? So royalty bad, active income good. So we check the box. So this is active income owned by Singapore. So it's not subpart F income. It doesn't get taxed back as earned. So we got this thing called the branch rule I want to talk about for just a minute that we always have to worry about when we do this. And it would take a while to explain it, but generally the branch rule would typically treat, in fact, there's an IRS, I dug it up this morning, there's a whole IRS publication, it's this thick, just on the branch rule in this one situation. So you might Google it or email me and I'll send it to you. But when you have a disregarded entity, now Singapore has a branch. And we'll use Canada as a better example. Singapore has a branch. And what the branch rule says is that when you have a tax reduction, in other words, the tax rate in Singapore is less than 90% of the tax in Canada, and you're actually reducing the tax by having this branch, which is what a disregarded entity is, then we're going to treat Canada and Singapore as separate corporations, and we're going to disregard the disregarded entity, in effect. Okay? And what happens if we do that? Well, now we've got this royalty going back, and we got subpart F income. Or alternatively, the way this usually works is you've got manufacturing going on in one country, and you've got sales going on in another, which is what we have here. So we're treated as though Canada is selling the property to Singapore. So Singapore is no longer a manufacturer and avoiding subpart F income. It's now buying from a related party and selling outside of its country of organization. So we've got that bad subpart F income again. That's a mouthful, I know, but you just have to be aware of it. How do we get around that? Taxpayers, we used to argue over this for years and years, and IRS litigated for years and years because they took different positions on what the case law said. I won't, I could talk an hour about, the interesting metaphysical reasons we got around it, but the way we get around it now is we've got regulations where the IRS finally resolved the argument, and they said, look, I'll tell you what, if you can provide significant services at this level, we're not going to treat this as just an agent of our Singapore company, and we'll avoid you having subpart F income in this scenario. So there's more to this structure than just these boxes. There are a few other technical requirements we have to comply with, and that kind of summarizes it at a high level. You'll find a lot of commentary in depth about how this works on our website if you really want to know. But I just wanted to pause on that before we get to the PFIC part. Okay?
Thank you. Okay, the PFIC rule. So I modified the structure a little bit, a lot actually, because we didn't have a PFIC issue. Assume for the PFIC purpose that we have an entirely foreign structure to begin, and now, now we have a new investor who is a U.S. person, wants to invest directly to this Singapore holding company. And the issue here is that for PFIC, you do not need to control the foreign corporation. It doesn't matter that even you only have one share or 1% of the foreign company. The PFIC rule applies to you as a U.S. investor. And the importance of the definition is down here. Is the foreign holding company will be a PFIC if it has 75% or more of its income passive income, or 50% or more of its assets that generates passive income. So if you have like significant active business here, then you do not need to worry about PFIC. And the consequence of PFIC is similar to the CFC, that you have a dividend each year to the new investor. Well, the issue here is as a 1% shareholder of the foreign company, the most of the case you do not know what is the deemed dividend is, because you cannot control the foreign corporation to distribute you any dividend, and you cannot force the company to disclosure to you that how much profit they made this year, so that you could report your shares to the IRS. So in dealing with that, the IRS provides the three methods that you could use. The first one is you just wait there and say you didn't do anything until the final dispose of your interest of the foreign corporation. And in that case, the IRS will treat it as you have received the amount ratably during the whole process that you holding the stock of the PFIC, which what we saw in practice is usually more than 20 or 30 years. In fact, that the people who caught by the PFIC rule is usually who never thought about PFIC issue. They received some property in a foreign country and they never report it to the tax return. They never thought about report it. And then they holding the property for 20, 13 years, and finally they sell the property and receive a big check, and they deposit it to a foreign bank account. And the next day, the bank called them, said that, under the new FATCA rule, we have to report your information to the IRS. And that's how they realized that, whoops, I have a problem here that I never disclosed. I have this property. And that's a very unfortunate situation for a taxpayer to be in. So if you realize that you may have an issue of PFIC, we always suggest you to make the mark-to-market election or the QEF election. The mark-to-market election is only available to people who, in the situation that the foreign company is a public company that listed in a public trading stock market. So the IRS is saying that instead of calculate the underlying share of your profit, we just compare the price of compare the stock price at the beginning of the tax year and at the end of the tax year. If you have a gain, then we deem as you receive the dividend, and if you have loss, we give you that loss. But the problem is they usually don't have any money to pay that dividend, because in fact you did not receive it. And when the stock value shows that you have a gain, it's not actual gain, because the stock price may go down in next year. So it's not real a good choice too. And the QEF election is qualified electing fund election, which you could make and give you the similar situation as the mark-to-market election, but you also have to receive an information report from the company to make that election. So for most of the individual small shareholders, it may not be a choice. The best solution we can suggest is that to avoid the PFIC situation, if you can, and if you cannot, always find a CPA and find a tax lawyer and make those elections. There are also restrictions on the mark-to-market and the QEF elections too. They're very complicated rules. Simply to say that put it simply way that you cannot make retroactive elections in most of the cases. For the QEF, you have to make the same election every year to the IRS. And transfer pricing. Okay, I will just give some introduction of the transfer pricing rules and let Roger to discuss about the details through the recent cases. The transfer pricing definition is, and in any cases, if there are transactions between two or more related parties, and the IRS has the power to do whatever they need to reallocate the income deductions or credits to prevent evasion of taxes or to clearly affect the income of the related parties. And the general rule under the transfer pricing, I'm sure you all hear of that, it's the arm's length price. And there's also different ways you could use to find the arm's length price. The CARP is the comparable uncontrolled price, and the cost plus and resale price is basically you leave some profit margin to one side of the related party, and you allocate all the others to the other party. And there are a lot of cases that the taxpayer and the IRS disagree about which rule they should use to find the arm's length price. And there's also intangibles. There are also special rules for intangibles, which sometimes people refer to it as the super royalty rule, that the royalty on the intangible must commensurate with the income generated by those intangibles. And that there are penalties for transfer pricing too, which Roger will discuss in detail later. And the transfer pricing issue may exist here between the sale between the related parties, and that's the more original issue of transfer pricing. But recently, it's actually here between the IP, between the transfer between related parties of the IP is where the most recent and most interesting cases about. And we see a lot of issues arise here, and the cost sharing agreement is what we use to deal with the super royalty rule, which I guess Roger will talk later. So what I want to cover before we dig into the transfer pricing cases is I want to talk a little bit about the ANTI-DEFERRAL. That is the interest charge domestic international sales company, which is a totally domestic structure, but has some similarity to the transfer pricing issue. As you can see from the slides, that essentially we just switch the sales company in a tax haven country to a U.S. domestic C corporation. It is a C corporation because to qualify as a DISC, you must have a C corporation in the U.S. And the idea of the IC-DISC is to achieve a tax arbitrage between tax on individual income and the qualified dividend, to provide a lower tax rate to the shareholders of the DISC. So give an example, what happens here is just the exporting company in the U.S., which, by the way, they are S corporations because for disregarded entity, you can get the income straight up to the shareholders so that it would be the qualified dividend to give you a preferential tax rate. So the exporting company form a subsidiary here in the U.S., and you file a form with the IRS to treat it as the DISC. And for federal tax purpose, the DISC is tax exempted. The company do not pay federal tax, but you need to be careful to check the state in which the company incorporated, because not every state recognizes the DISC. For example, California does not recognize a DISC, so you need to be careful about choosing the states of incorporation. And the exporting company pay a commission to the DISC, and the DISC then pay the dividend to the company, but because it's disregarded entity, then the dividend reported directly by the shareholders. So the tax arbitrage I mentioned is when the exporting company pays commission, it gets the tax deduction at the ordinary rates, which for the company is 35% or 39.6%. And because the disc is tax exempted, you do not have tax here on federal level. And then when it pays dividend to the shareholders, the U.S. shareholder has the qualified dividend, which eligible for the 23.8% tax rate. So you essentially save 60% of tax by using the disc. Of course, there are rules. There are rules to govern the commission, how much commission you can pay to the discs, but it's much generous than the ordinary arm's length rule under the Section 482 of the transfer pricing rule. So, it's just a very high-level introduction of the structure. We actually did a 1-hour webinar only on the IC discs with Christine, who's sitting down there, and that's the webinar and the slides is available on our Royse University website. You can have a look and download the slides if you're interested. And I guess with that, I will leave the rest of the time to Roger, talking about the recent case laws about transfer pricing and the other tax deferral regimes.
So let me just walk, these are a couple of different variations on the structure. One, this is a U.S. company. We set up so you saw the IP holding structure. This is one where we've got a tax haven company that actually does contract manufacturing through a Chinese manufacturer and sells products through base companies. This is a fairly common structure. So that branch rule issue I was talking about, where we've got these regulations that deal with it, this is a scenario they're aimed at, because the branch rule applies with respect to foreign-based company sales income, not personal holding company income. So we'd have to rely on an exemption. Here's another variation that we've used. Let's see, U.S. company, local distributors. Again, we've got a tax haven company taking service fees in this case. So the cases, so under cost sharing, remember, so two things. Number one is under cost sharing, remember we said that we're dividing up the costs based on the relative benefits that the parties get from the IP, which means that the U.S. company is going to forego some of the deduction because the foreign party is going to be paying for it, but it ought to work out for them because they're not being taxed on the income and they don't have to worry about licenses, etc. So the first two cases deal with cost sharing agreements. One is the original agreement, the other is a buy-in payment, because if the IP is already developed, then the foreign party usually is going to have to buy in. It's going to have to pay for their portion, and that's going to be income to the U.S. party that's receiving the buy-in payment when they sell the foreign rights in effect. So there's been, for as long as I can remember, this issue here in the Valley is what we do with stock-based compensation. The court in Xilinx up there, I don't have Xilinx listed, but that was the first case that came along quite a while ago where Xilinx held for the taxpayer against the IRS, and they said, gee, when we figure out what the costs are that have to be divided up and the amount that you have to get paid as a buy-in payment and what the cost of this is, we're going to exclude stock option costs, stock-based compensation in that determination, which means that the U.S. company that's getting the buy-in payment gets less of a buy-in payment because there's less cost to allocate. Big taxpayer victory. The IRS went and amended the regulations, and Altera came along and challenged, I think it was Altera, challenged the new regulations on the buy-in payment. But so far the cases have been going in favor of the taxpayer on this issue. Let's see, Amazon. I do want to talk about this Apple case a little bit. So, do we talk about, all right, in terms of big cases, because this is kind of a big deal right now. So, have you ever heard of BEPS? Okay, some of you have. So, where to begin? So there's the OECD has undertaken a massive international project on base erosion, BEPS. That's the BE in BEPS, and how the law ought to be revised. And we've got an extensive treaty network, and we've got a system in place for transfer pricing because this is an international issue, right? And one of the things a lot of companies, the bigger companies, are doing, like Apple, is they enter into advanced pricing agreements in foreign countries. They just go negotiate with the country, and they get an agreement, and it's approved in advance, and this agreement will set forth the pricing that is to be applied. And that way we don't have to end up litigating the whole thing. They don't set a price, the tax authorities challenge it, and then we litigate it, and we go through competent authority, so all the countries involved are on the same page. Because if you increase prices in one country, you're reducing them in another, in effect, right? That's what transfer pricing is. Well, the EU has a different approach. They have this concept called state aid. And under EU law, one country is not supposed to provide state aid. In other words, an unfair advantage or some sort of state subsidy to companies to locate there. And the EU has ordered Ireland basically to charge Apple additional tax because they don't like their pricing. They think it's unfair, and that the pricing agreement itself, the taxation on the pricing that Apple's using, is a form of state aid. So the EU has ordered Ireland to impose an additional tax on Apple. The amount of the additional tax is enough to fund their entire healthcare system in Ireland. It's an enormous amount. This is really big, this state aid issue. This kind of turns everything on its head. It means that all of the work we've all been doing on advanced pricing agreements could be turned around by the EU. That the countries' individually negotiated agreements are not going to be respected. And the worst part for U.S. companies, if this continues, is that the IRS will probably not allow tax credits for about foreign tax credits. Will not allow credits in the U.S. for the additional taxes they pay to Ireland because there's this rule that you can't pay a voluntary tax, etc. You got to go fight it forever and ever. So in effect, what's happening here is that Europe is being financed at the expense of our tax credits. So this is getting to be more and more of a problem. And the solution, I'm afraid, is it's going to be what's going to happen in all of this. If one thing should become clear when we look at all of this is that we have an extremely complex system here. And we all know that our system is out of touch with the rest of the world because we tax on a worldwide basis. Most of the world taxes on a territorial basis. And the answer, of course, will be to change our system to a territorial basis so Apple doesn't have all this incentive to put a lot of income in places like Ireland, and we won't have this issue about state aid. Hopefully that's where things will go, but for now, I don't represent Apple, so this is more intellectual curiosity at this point, although it may seep down to my level. Let's talk about a couple of other things. Earnings stripping. Another big issue. This is where, just imagine, we want to get money out of the U.S. So parent company has a U.S. subsidiary. It can put the capital in as equity or can put it in as a loan. We all know that if it goes in as a loan, there's deductible payments that go out of the subsidiary. So Section 163 has a limitation. It limits the debt equity ratio that the U.S. subsidiary can have in order for the payment of the interest to be deductible. That's been around for 25 years now, and that's nothing new. I've just not run into it. My clients are just not quite that tax motivated that they violate that debt equity. They're much more concerned about, they'd rather pay a little more tax than have this obligation to pay the debt back and have to pay interest every year on it. But 163 limits the deductibility. What the IRS, I think, has found is that 163 hasn't gone far enough. It hasn't been a good enough disincentive to companies having too much debt in their cap table in order to get deductible payments. So recently, remember 385? Code Section 385 enacted about 1 million years ago, and the IRS has finally gotten some regulations under it, some debt equity regulations that have caused so much problem in so many different areas that the Senate Finance Committee actually sent a letter to the IRS saying, knock it off. And the IRS did. They backed off in a number of areas. This is not international, but those of you that do S corporations, these debt equity regulations, could have had the result of recharacterizing shareholder debt as equity, creating another class of stock, and terminating your S election. That's one example. They backed off of that. But the other example that we were concerned about in the international area is that they would treat this loan, the interest payments on the loan, as non-deductible dividends. When we had what they call foreign issuers, foreign-related issuers. The IRS is not including that in the new Section 385 regulation. So for now, anyway, we don't have to worry too much about this transaction being recharacterized under 385. Okay, let's switch gears for a minute. I want to talk a little bit about the inbound side, because that's what we probably do most of. And this is where we have before we were talking about our U.S. companies that want to go offshore and set up these foreign structures. Let's talk about foreign companies that want to come into the United States. So what's the issue that we need to worry about when that happens? Effectively connected income, right? So if a foreign company has income that's effectively connected with the U.S. trade or business, the foreign company is taxable here on that effectively connected income. You can generally think of it as U.S. source income, but that's a pretty inexact definition, actually, because some foreign source income can theoretically be taxed here. 99.9% of this is fun to talk about, but doesn't come up in practice much, because 99.9% of the foreign companies that I work with will form a U.S. subsidiary just to avoid this issue, right? Foreign company owns U.S. sub. But that's not the end of it, because we have this dependent agent idea. So a foreign company hires somebody here in the U.S., and I think of a dependent agent as a lot like an employee. It's subject to control, but there are a couple of big cases out there that say it's a little worse than that. There's this thing called where the entrepreneurial risk is taken away. If you take the risk away, the financial risk and the entrepreneurial risk away from a party, like we do with these strip distributors that we use, that corporation in the U.S. could be a dependent agent. So we have to be a little bit careful about it. Fortunately, usually we have an income tax treaty that takes care of this whole issue, because we're going to get to treaties in a minute, so let me pause on that. But absent the treaty, what we're worried about is having a U.S. office, which is a place of business in the U.S., and having income that's connected to that U.S. office. If we have that, we end up with effectively connected income, and not only that, we've also got the branch profits tax, and what that does is it taxes a branch in the U.S., which remember is just a U.S. office now, with effectively connected income, taxes it the same as a corporation. So it imposes a secondary dividend tax on any amounts that get repatriated from the U.S. Okay, so here we have holding company. We have U.S., foreign holding company, U.S. company, just what you would expect. But I do want to talk about the treaty. On this particular issue, the treaty raises the requirement, so it's not just internal law we look at. There also has to be a permanent establishment in the U.S., which is a little higher standard than just having an office here. But I want to go back to this dependent agent idea, because that's where we run into trouble, even under treaties, is that if we have an individual in the U.S. who has the authority to negotiate and conclude contracts on behalf of the foreign party and regularly exercises that authority, we may end up having a permanent establishment in the U.S. And there's cases and cases and cases. It's very fact-based. But if you work in this area, you remember that the one racehorse is different than two racehorses for this determination kind of cases. But more recently, there was the Tassai Fire and Marine case, which found dependent agents because of this entrepreneurial risk shifting idea, and LTV, which was in the financial services industry, took a good hard look at this issue. So everything I just said is supplemented by treaties. The dividend withholding that we talked about, if we have a treaty and if somebody claims a treaty benefit, they can get a reduced rate of withholding, maybe down to zero. Same with interest, same with royalties, and then service income has to be subject to. You know, the thing about treaties to keep in mind, the thing about treaty benefits is that treaty benefits have to be claimed. So I'm not a big fan of just relying on the treaty. I'd rather avoid it if we can, because you have to claim a treaty benefit. And I've been doing this long enough where parties mess that up. You know, they don't file their W-8, or they get it wrong, or they don't want to get into the U.S. tax system. But it's not automatic, and sometimes people forget about that. But if you do have somebody who needs to rely on a treaty and is sophisticated enough to do so and is willing to claim it, you know, that's a way out of a lot of our withholding tax rules, as well as our ECI rules. What happens if we get the transfer price wrong? Fiona mentioned that there are understatement penalties depending on how far off the mark we are, and the penalty can be 20% or 40% of the underpayment of tax. Now, we talked about the cost-sharing agreement, which is usually supported by a study, but I want to talk about adequate documentation a little bit, because this is a little bit more subtle. So the rules say that if we have adequate documentation, even if we're wrong on the price, we're not going to pay any of these penalties, all right? So, and that's what we refer to as a transfer price study, prepared by a professional, economist, a lawyer, a CPA, professional in the area that meets certain standards under the regs. And then we avoid paying these penalties, even if the price is wrong. So as a practical matter, in audit, you get audited, the IRS looks at your numbers, you hand them the penalty study, and they go look for lower hanging fruit. Now, not always. I mean, because I've been in these cases where the study is so far off, you know, it gives you such a good result that the IRS will challenge it, and then they hire an economist, and you hire an economist, and you let them fight it out. But that's the penalty study. But there's two kinds here. One is just to avoid penalties, right? So you're not being that aggressive on your pricing. You're paying some tax. You just have this, you know, you have one of these mills, or maybe you have a valuation firm put one together. It's a study, and you put it in a file. You don't have to file it with the IRS, unlike other countries. We don't do that here in the United States. You just have it in a file, so that when you get it audited, you get the first IDR, and you send that over, and the service looks at that, and they check the box, and hopefully move on to the next issue. Under that arrangement, you're just avoiding penalties. But then there's another level here, and people kind of talk about these interchangeably, but they're much different, and that's the transfer price study itself. That's where we really are trying to squeeze every last dime out of this structure that we can. So then we'll get a much more involved, in-depth, well-considered study done hopefully by an economist that really does justify why you have so little income in the U.S. and so much in some low-tax jurisdiction. And that's the one that you prepare when you're loading for bear and you know you're going to have a fight. And that's how we used to do it. These days, I know in bigger companies, people want to get advanced pricing agreements just to avoid the fight. But just keep in mind, you know, definitely, if you're doing more than $10 million a year, you know, you should consider adequate documentation. At that level, it would be a penalty study. If you're doing more than $40 million a year, you might want the transfer price study, because now the numbers are big enough where you can actually save some money. We've got a few minutes for questions. 4 minutes left, if anybody has any. Yes, sir.
Can you please elaborate on the new rules on country-by-country reporting in the U.S.? Country-by-country
reporting? I can't. Can you?
Transfer pricing?
Yeah, you mean transfer pricing, the country-by-country reporting for transfer pricing.
Do you have any clients that may be in that situation?
I don't think I do. I'm aware of them, but nobody's paid me to look at them yet. Do you know, Fiona?
Do you, so you don't provide transfer pricing service?
No, they
What do
don't.
you use?
You know, it depends. Like I say, this penalty study, those are kind of a commodity, I think, and you can find a lot of places that'll do them. I mean, it's dirt cheap compared to what it was, 20 years ago. But if it's something more sophisticated, like a transfer pricing study, then it'll have to be an accounting firm that has an economist, I think. You guys do them, right?
Yeah, we do them. Yeah, and we do both types.
You do both types. Okay.
And we're doing a number of IP shifts right now, so, and those are usually the more expensive ones because those are sort of the crown jewels.
Yeah. The IP shift, the IP valuation when you do the cost sharing. Yeah.
And then we'll evaluate against the reasonable and anticipated benefit is the RIB on an annual basis.
Okay.
But to your point, they did update the 6038 regs to allow for C/C reporting as part of the 5471s. I'm sure a draft of that form will be available here soon, but I haven't seen it yet. The nice thing that actually Treasury really went for is that data is only available through treaty information requests. So IRS will hold all that data from the U.S. parented companies until they get a treaty request from the foreign governments.
Okay. Okay, with that concludes our presentation, concludes today. I hope you'll stick around. We've got some snacks here. There should be some drinks out front. I want to thank all of you for being here today. I want to thank our speakers for presenting all day long, and we'll hope to see you again next year.